This week, the financial world just experienced an absolute thriller. The S&P 500 just did something it's never done in history. The Nasdaq rode an absolute pure wave of artificial intelligence adrenaline, extending what has been a historic multi-week winning streak. Tech giants and infrastructure names are adding tens of billions of dollars to their market cap in a single trading session, leaving short sellers utterly decimated. But look beneath the surface and the situation becomes deeply unnerving. Even as the headline indexes notched new records, a massive tectonic shift was happening behind the scenes. Big money started aggressively buying up protection in the options market. Geopolitical variables are fluctuating wildly, and the Federal Reserve is lurking right around the corner, waiting to drop a hammer on this party. So are we on the verge of a legendary summer melt up that will push tech multiples into the stratosphere? Or are retail investors walking directly into one of the most violent bull traps ever engineered? The AI infrastructure trade has completely re-rated the tech sector as a whole. The bulls are screaming that this is a structural generational paradigm shift. If a legacy giant like Dell can grow its AI server business by over 175% in a single year, the addressable market for enterprise AI development is far larger than even the most optimistic Wall Street analyst can predict. They're arguing that high stock multiples are entirely justified when net income is growing at an exponential velocity. But the bears have a completely different take. They argue that what we're seeing is a classic cyclical capex blow-off top characterized by massive front-loading and panic buying. Corporate enterprises are terrifyingly over-allocating capital to data centers out of FOMO before they even have a clear monetization strategy for the software side of AI. Furthermore, below the surface of the index, we are seeing major warning signs developing. Alphabet recently dumped $80 billion worth of its stock to fund its own capital expenditures, and major tech players are starting to dilute shareholders just to keep up with the hardware arms race that's happening right now. So when this AI infrastructure build-out hits a natural saturation point, the drop-off in demand will be catastrophic. Now, you also need to keep in mind that while tech was grabbing the headlines, the commodity complex experienced an absolute bloodbath that completely reshaped the inflation narrative for the S&P 500. For months now, the market has been plagued by massive energy risk premiums after geopolitical tensions threaten key supply lines in the Middle East. This reaction to the oil pit was instantaneous. Brent crude, which had been anchoring the energy sector's massive performance, plummeted directly through the psychological level of $100 per barrel. The energy sector went from being the market's absolute darling to the single heaviest drag on the S&P 500 this week. Then, directly after this massive crash, with the flip-flop that's happening within the narrative around the Middle East, the oil sector is now back up, and the cost per barrel is continually increasing due to these new tensions that are coming through. The bears are seeing an incredibly dark omen showing in the charts. They argue that oil isn't just falling because of diplomacy, it's falling because global macro demand is fundamentally fracturing. The international trade deficit is incredibly wide, and domestic consumer metrics are showing deep fractures. The bears point out that lower commodity prices historically preceded an economic slowdown. If oil is collapsing because industrial demand is drying up, then the broader S&P 500 earnings projections for the second half of the year are wildly overstating consumer health. And the final, perhaps most dangerous catalyst playing out right now is the deep divergence inside the domestic economy. On one hand, backward-looking macro data is trying to paint a picture of a stabilizing economy. The Fed's preferred inflation metric, the Core Personal Consumption Expenditure Index, came in at a sticky but stable 3.3% annually, while the federal funds target rate remains locked at a restrictive 3.5% to 3.75%. But look at how this is actually affecting the corporate landscape. Recent corporate earnings from major retail giants are revealing a stark, highly alarming wealth divergence. While high-income consumers are still spending, lower-income demographics are completely tapped out. Middle and lower-class shoppers are aggressively trading down to discount discount models, driving massive volume to dollar stores and essentials while abandoning discretionary purchases entirely. This is happening at a time when major financial institutions, particularly large lenders, are aggressively building up a massive loan loss provision. Banks are proactively hoarding cash and building massive reserves because they're openly preparing for a significant deterioration in the consumer credit cycle. The optimistic crowd believes the market has completely neutralized the Federal Reserve. Wall Street has already fully priced in a higher for longer interest rate regime, with models showing virtually zero expectation of a rate cut through the rest of this year. Now, despite these restrictive rates, corporate profit margins are holding up beautifully. The fact that the S&P 500 can hit new all-time highs while the Fed is holding the rates near 3.75% proves that the modern corporate engine is incredibly capital efficient and entirely decoupled from the central bank dependency. The bears believe that the retail crowd is completely blind to the macro reality. They point directly to Warren Buffett's Berkshire Hathaway, which has quietly built up an unprecedented historical cash hoard of approximately $400 billion. That represents nearly half of Berkshire's entire investment portfolio, sitting strictly in cash and short-term treasuries. So why is the greatest investor of all time refusing to buy equities at these levels? When the consumer credit default cycle accelerates and hits corporate balance sheets later this year, the current historically high stock valuations will face a massive unhedgeable multiple contraction. So we're sitting at an absolute crossroads in market history. On one side, you have AI technological revolution and geopolitical relief valves pushing the headline indexes to jaw-dropping all-time highs. On the other side, you have smart money buying protective puts, consumer credit cycles deteriorating, and Warren Buffett sitting on a mountain of $400 billion in cold hard cash. This is exactly where fortunes are made and completely lost. So the question becomes, which side of history are you going to end up on?